Well, thank you for tuning in. I thought I would make a very, very brief video on the differences and similarities between ETFs and mutual funds. I think sometimes we can get caught up as advisors in the complexity of things. We don't always just break down and compare the simple concepts that help people feel empowered and engaged in their financial planning and investment portfolios. So let's hop in to what an ETF is first. It just stands for Exchange Traded Fund, and it is a pooled investment strategy. This is actually a similarity with mutual funds. They both are, generally speaking, pooled investment strategies, which means that the vehicle itself is comprised of stocks and bonds inside of it, or commodities, or whatever it might be. But it is, you buy the ETF in this case, and let's say it has a couple hundred stocks inside of it as underlying holdings. Then that's how you would get exposure to those stocks. It is a little unique in the way it trades. It trades like a stock or a bond. So in Texas, for instance, the New York Stock Exchange is open from 8:30 to 3 p.m. Central Standard Time. So all throughout the day, you can buy and sell stocks, bonds, and ETFs. And again, that is how it trades. Similar to an ETF, a mutual fund is also a pooled investment strategy, meaning it is comprised of underlying securities as well. So stocks, bonds, whatever that might look like. It's a little different in that it only trades once a day at 3 p.m. So everything happening throughout the day is not necessarily relevant from an investor perspective. They're not seeing that. They just see the price at the end of the day. Generally speaking, mutual funds are run by portfolio managers, although not always. But when you think of mutual funds, at least very high level here, mutual funds are typically thought of as more active manager as opposed to passive, which brings me to the similarities and differences. So the lines have become more blurred more recently, but traditionally, and again, this is my perspective, but I think that this generally rings true for most people who've been in the industry a while. Mutual funds have been thought of traditionally as actively managed, meaning that there is a person or a team of people doing research, really investigating what investments, stocks, bonds, commodities, whatever, they want to include in the strategy and which ones they don't. So that active management brings different things to it. It is up to the investor to consider whether they want to employ that strategy or a more passive one. I think traditionally ETFs have been thought of as more passive investments, meaning that they are going to track the performance of an index. Although, again, the lines have become blurred more recently. And as I mentioned on that first slide there, ETFs trade a little bit different than mutual funds. They even exchange securities inside of them a little bit different. So there are pros and cons on why you'd want to use an ETF over a mutual fund. But traditionally speaking, I think ETFs have been considered more passive. But that is changing. So there are mutual funds and ETFs, and those lines are a little bit blurred. But generally speaking, it has to do with the mechanism by which they trade, and then historicacally, if they're more active or passive. Again, there's a few other things to consider, but I'm going to cut it off there. If you have more questions, of course, I'd welcome you to reach out to us. We would be happy to go through them in more detail and explain what may or may not make sense for you and your individual financial plans and goals. So thank you for tuning in. Any questions? Feel free to fire at us. Thank you.